Welcome to this special coverage. We are decoding the fine print of Budget 2024, and there are so many changes on taxation to speak about. The market has been reeling under pressure and under disappointment because there is an increase in the tax incidence that you and I will have to contend with when it comes to investments in listed equities. I have with me Kalpesh Desai, who's partner, deal advisory and M&A tax at KPMG. Kalpesh, thank you so much for joining in. I don't think we've had such a tax-heavy budget in a while, right?
Yeah, it has been a while. Generally, we have seen the finance minister has tried to make the budget that much more simpler without too many changes. This time, it's been really heavy on that.
Oh, absolutely. So, we want to keep it really simple for anybody who's joining us right now on our digital platforms. Let's take it step by step. And I'm going to start with the biggest blow first,
Sure.
Which is capital gains tax, right? So there were a slew of announcements on listed, unlisted, financial assets, non-financial assets. Just take us through what has happened.
This is the most interesting one that we saw. There was a little bit of an expectation. I think the expectation was set during the previous budget when the finance minister somewhere said there is a parity needed between the domestic investors and international investors' capital gain, and the capital gain tax regime anyways was a little burdened with too many classifications. For long-term classification, the period of holding was 1 year through 3 years, and the rates were really different. What she has done is she has tried to classify this in actually now 2 or 3 classes. By period, she has said if it is listed, you get long term at 1 year, otherwise it's short term. In case of unlisted,
Which was already the case.
Which was already
listed
there.
was always 1 year.
But for some of the unlisteds, there was a period of holding of 2 year versus 3 year. Now she has made everything at 2 year. So that's one big change that she has made. The second change that she has made is around the rate of taxes for long term financial as well as non-financial assets. It will now be taxed as 12.5 as compared to, let's say, listed shares which were taxed at 10%. Now, therefore, unlisted also you get a 12.5 rate of tax, which earlier was 20%. For listed short-term, specified assets, she has said the rate will increase from 15% to 20%. It means that the remaining of the short-term will continue to be taxed at ordinary rate, which is applicable to you.
Okay. So basically, the 10% long-term capital gains on listed equity goes up to 12.5%. But that 1 lakh rupee exemption limit has been hiked to 1,25,000.
Yeah, that's interesting that she has done. She wanted to leave a little bit more in the hands of the smaller taxpayers. So she has, apart from many other things that she has provided for, one additional thing that she provided is increase the exemption limit from 1 lakh to 1.25 lakh.
Okay, short term, if you're in the market for quick gains, then be ready to pay 20%.
20% from
STCG, that's what we have, and that's the long-term definition. Okay, just for clarity, and I'm looking at the notes over here, no change with respect to debt funds or any sort of debt instruments. What about property? What happens to capital gains on property?
So property now will be eligible for a 12.5% rate of tax if you have held for 2 years plus.
Which means the tax rate on property is coming down.
Has come down. However, the indexation benefit has been taken away.
Oh.
So if you were eligible to take some indexation and were able to bring your rate of tax down, now you will no longer be able to do that. You will have to pay 12.5 on the capital gain that you make.
Okay.
On the interest yielding capital instruments.
Just to complete the point, because indexation has taken away, which indexed the cost to inflation. I mean, I know it's very early, but overall, is it a blow or is it actually a relief when it comes to capital gains tax on real estate investments?
Actually, it's a mixed question because it depends on for how long you've held the property and how much is the gain that you're making. In some situations, as a result of the indexation, your effective rate of tax could have gone much below. It could have been actually a loss.
Yeah.
Whereas now we will have to ignore the indexation. Whatever is the rupee gain that you have, you will have to pay 12.5 on that. So in some situations, you may end up paying more tax than what you would otherwise would have paid. In other situations, you will save some taxes.
Okay, so not quite a straight line. Now let's talk about speculation in the stock market, right? Which has become such a huge issue. In the last 1 week, we heard, the SEBI chairman talk about it. There was some reference on the RBI governor's part as well. We saw it in the eco survey, and now it has happened. So more gear up for higher securities transaction tax, right?
That is correct.
On F&O.
That is correct. So she has actually, and this has been very clearly coming out from various sources that they didn't like the volume in the F&O segment. And they also didn't like the retail participation as much as as much as they could do something about it. I think they found a very simple way to dissuade the public from participation. They said we will now increase the STT rates on the F&O from something which was applicable at like 0.0625 on options to 0.1% and 0.0125 to 0.2% for futures.
So pretty steep increase, right?
It's almost like a say of 60% to 80% increase on both the cases.
Okay, so you really have to think whether you can stomach, you can, trade smart enough to make up for this increase in taxation,
This will increase the cost of trading in futures and options, so it will dissuade some of the players there.
Okay, so that's the second, tax from a capital market standpoint that you need to be sort of aware about. We're not done yet. Third issue, which is going to impact what our investments mean in the capital markets, and that is buybacks. Remember, of late in the last 1 year or so, we've seen a lot of large companies announce big buyback programs instead of big dividends. That also had a tax element to it. Now it seems that buybacks are going to be taxed just like dividends, right? Explain that to us, Kalpesh.
So that has been boiling since some time. The finance minister has been thinking about it, how to treat the buybacks as compared to dividends. A lot of companies were taking a lot of cash out, especially the promoter-driven companies. They were taking a lot of cash out by announcing buybacks as compared to declaring dividends. Dividends actually were taxed at ordinary rates and were therefore subject to tax at about, let's say, 35% in the case of individual promoters.
So if I was a shareholder and if the company was paying dividend, let's say 100 rupees of dividend income comes to me, I simply need to treat that as part of my overall income and pay income tax at my slab rate.
That's correct.
That's how dividends work, right?
That is how dividends work.
Yeah.
Whereas the buyback was taxed in the hands of the company, not in the hands of the shareholder.
Correct.
In the hands of the company, to the extent there was a difference between the amount that is paid out by the company and the amount that the company had originally received at the time of allotment of shares.
So
this was treated as...
Explain that. What does that mean?
Let's say the company allotted shares at 10 rupees per share.
Okay.
And the company is implementing buyback at 100 rupees per share.
Right.
So the 90 bucks, that is a difference between the two, that is subjected to buyback tax at about 20%.
20%.
Now the finance minister has proposed that it will no longer be subject to a buyback tax. The amount so distributed will be treated as, the entire amount so distributed will be treated as dividend.
So the 90 rupees, let's say I'm tendering my shares in the buyback.
The way I read the fine prints, it seems that it is the entire 100 rupees that will be treated as subject to buyback tax, subject to dividend tax.
Which is at the slab rate.
Which is at the slab rate. The other fine print that I read is that for generally treating something as dividend, the company must have accumulated profits, out of which you can pay dividend.
Sure.
For this part, they are saying that whatever is the amount distributed, that amount will be treated as dividend.
Okay.
Regardless the company having any reserves or not.
Okay.
So that's one change that I noted. And the second thing is, therefore, the shareholder will end up paying tax on the entire amount that he receives under the buyback. The question then arises is, what happens to the cost of the shares in the hands of the shareholder? For that, they have provided a beneficial provision saying that the cost will be now treated as loss in his hands.
Okay. So again, to go back to your example, if the original price of the share was, let's say, 10, and the company was buying it back at 100 rupees, I mean, my cost of acquisition was, let's say, 10, and the company was buying back at 100 rupees. So to that extent, the gain that I'm making is 90 rupees, or the income that I get is 90 rupees when I tender that share in the buyback.
But the amount that will be treated as dividend in your hands is 100.
Okay.
And 10 of your cost will be treated as capital loss.
Because that's the money I spent in acquiring the share.
In acquiring that share, which you can then offset against any other capital gain that you make in the future. Okay,
so the amount or the price of the share will be treated as a capital loss to be offset against your capital
any other
gains.
Capital gain.
And the rest of it is basically, it's a dividend, so you pay full tax on it as
full tax on that.
Slab rate. Oh God, does it get any better? I'm thinking this is the third major point we've discussed, and it's all negative. Okay, so let's try and give it a little more of a positive spin, right? Personal income tax, some minor little bit relief here and there.
It's a good relief to some extent if you look at it. Individuals who opt for the new tax regime. There's a little bit of a tinkering in the slabs that has been done. So if the slabs were, the base of the slab remains the same, the top line of the slab remains the same, there's no change in between. The rates of tax generally remain the same. But in between the slabs, finance minister has proposed to increase and provide a little bit more reduced rate of tax on overall basis to the individuals. So the rate of tax which was falling within, let's say, 5%, where the rate of the income was anywhere between 3 lakh and 6 lakh, it could have been 5%. The higher end of the slab has been increased to 7 lakh rupees.
So now it is 3 to 7 lakhs.
3 to 7 lakhs at 5%.
At 5%.
Similarly, the next slab, which was at 10%, she has amended that. That will now be applicable from 7 lakh to, instead of it up to 9 lakh rupees, it goes up to 10 lakh rupees.
So 1 lakh rupees sort of relief coming in, because you by 1 lakh you come into the lower slab. And
The
you
effective outcome that the finance minister estimated is about 17,500 rupees per individual. That's a good amount of saving for individuals following the new regime and falling within that bracket.
You know, when she announced that standard deduction is going up from 50,000 to 75,000, finally I wanted to like rejoice. But I'm in the old tax regime, so nothing in it for me, right?
For old tax regime, no changes. It's only for the new tax regime. You have to opt the new tax regime for you to get these benefits.
So the standard deduction increase is only in the new tax regime, not in the old tax regime.
In fact, she made that observation at the beginning somewhere that about 2/3 of the taxpayers who are now opting for new tax regime. And she's actually liking that. She's thinking that more and more people should be going in that direction. It will simplify our tax filings and computation.
So old tax regime people, nothing. ATC remains at 1.5 lakhs. Those usual deductions, home loan interest, etc. Nothing increases, right?
Nothing changes.
Okay, so there you go. Straight face if you're in the old tax regime. Let's move to some other aspects. There was something on NPS as well, I remember, where I think even private sector employees can get benefits of some higher deductions. Just tell us what that is.
Somewhere it seems that the finance minister assumed that there is a need for increasing the savings and diverting that savings in a different way into the market, and also providing some level of security to the working class population. So what she has done is she has proposed to increase the NPS related deductibility in the hands of the private sector, some banks and some public sector employers, where they were able to get a deduction for contribution that they made for the employees quota into NPS from 10% to 14%.
Okay.
A similar increase has been provided for the employees who contribute into NPS. So both together can now contribute up to, from 10 to 14 and therefore 28%. So
basically this is good news, right? Because if I was an employee contributing, let's say on, out of 100 rupees, 14 rupees or 10 rupees I was getting a income tax deduction, but now I'll get a deduction on 14 rupees.
That's correct.
And not just 10. And likewise for the employer as well.
So that just increases the advantage and incentive for both to contribute a little bit
more
higher
money in NPS.
And therefore increase the savings as compared to just increase the consumption.
Okay, so a little bit of a sweetener for NPS for long-term retirement savings and retirement planning if NPS is the vehicle that you wish to offer. And remember, anyway, there's that section which gives 50,000 rupees of additional deduction over and above ATC, right? That's the NPS overall deduction that you get when you're contributing to NPS.
Also, there is a provision for now, a scheme where a guardian or a parent can start the NPS scheme for the minor kids.
Oh, yes,
which they can pass over and continue in case the minor becomes major and they want to continue. That's an added advantage.
Correct. So this was, I think, the NPS Vatsalya Yojana. I remember the name.
Correct.
So NPS has been sweetened for both the parents and guardians who are contributing, or if you're an employee, you yourself want to sort of contribute more. There are sweeteners from the employer's point of view, the employee's point of view, and the parents and guardians as well. Now let's come to some other issues beyond personal taxation. There was a lot of talk on TDS and TCS provisions, tax deducted at source, tax collected at source, which I think is really complicated because we have some 30 different rates and God knows going over all over the place, right? So what is the change?
So, the TDS provisions government had introduced many years ago, thinking that it will be a way in which they will be able to track some of these transactions, where the payer of the amount will at the source deduct some of this amount and deposit with the government. Over a period of time, the number of transactions which will be subjected to TDS increased. Also, some of the transactions where I had to make the payment, the recipient of the money was obliged to then collect additional money from me as TCS and deposit with the government to make sure that I am reporting that transaction appropriately. So TDS and TCS in a way became really a complex maze. Different provisions apply to different types of transactions, and therefore there was a debate in terms of a TDS should be applicable on a particular transaction at 2% or 5%. That was leading to a lot of debate and litigation.
Okay.
With a view to reduce that litigation and simplify those provisions, the finance minister has proposed that all of the provisions where 5% rate of tax was TDS was prescribed should be reduced to 2%.
Got it.
Effectively, it will it will allow increased level of working capital to the
lesser outgo of money.
Lesser outgo, cash flow management will be better. At the same time, the litigation will also be a little lesser.
Will go down. So that's good news.
That's a good news.
And finally, I mean, I guess startups have reason to cheer. Maybe startup employees as well, because this tax called angel tax.
That's a big one.
That's gone, right?
That's a big monkey off the back. The angel tax has been there for many, many years. A lot of this new age.
And there was nothing angelic about that tax. From the startup perspective, right?
From the startup perspective, certainly not. But it was putting a lot of burden on them, going and getting valuation reports, and then when the market is good, it's that much more better. But after raising of the capital, if the market goes down, to then go and prove that the valuations at which they raised capital was actually fair at that point in time when I raised the capital was really burdensome, and that led to a lot of litigation. Government had tried to introduce some of the exemptions. Last year, for example, they introduced an exemption by saying that if AIFs were to invest, they will not be subjected to some of this test. If sovereign wealth funds were to invest, they will not be subjected to this test. And if investors who participated alongside the AIF in sovereign wealth funds, then they, up to the level of investment that AIF is making, they will not be subjected to this test. But it was still really complicated.
A lot of litigation, I guess.
A lot of litigation. And a lot of paperwork around it. So government has somewhere decided not to levy any further angel tax, and it will no longer be applicable go forward basis.
So I guess at least startups and at least people who are opting for the new tax regime, they have reasons to be happy. So what's your score? On a tax scale, 1 to 10, how does the budget rate?
It's too heavy. For that reason, I will go a little bit lower. Otherwise, I would have given 10 on 10, but I would now go with 8 on 10.
Okay. All right, Kalpesh, thank you so much. Lots of tax announcements, and thank you for helping us make sense of them. Thanks so much.
Thank you.
Thank you for being with us. More coming up in just a bit.